Yes. There we go. Well, hello, everybody. Welcome. Thank you for joining us today. I am Leticia Emi. I have the pleasure of being joined today by my colleagues, Sophia Sanderji and Noshin Nova, and we have two fantastic speakers, Danet Liv from Incofin and Antonia Sariska from UBS Global Wealth Management. Today, we have a great presentation. We're going to be discussing the findings from the recently released report, Impact Investing Decision Making, Insights on Financial Performance. What we have learned through this research is that impact investors are approaching decision making with increased sophistication, applying a multidimensional approach. And so the plan for today is to start with some of the top line findings from this report, and then shift gears to hear from our speakers, both from Danet and Antonia, to hear how does this multidimensional decision-making look like in practice. And we're going to reserve some time for Q&A towards the end. Some housekeeping notes, and I need to do a better job of this, but we're going to keep everybody's line on mute throughout the presentation just to preserve audio quality. We are recording today's session, so if you know of any colleague who would like to attend today but couldn't make it, please know that we are recording. We'll have the link on the Aris Plus website, and we can share that after the session. And we're going to, as we said, do Q&A towards the end, but we would love for you to use the chat function to start sending your questions as you have them, so that we can open up to Q&A towards the end. So with that, I'm going to pass it to my colleague, Nova.
Thank you, Leticia, and thank you so much, everyone, for joining us today. We are so excited to share some insights and learnings from our recently published report, and hear more from our speakers on how those insights inform real-life decision-making. As you know, just a little bit of context on this report, it draws on the 2020 Annual Impact Investor Survey and several other industry research to dig deeper into the performance of impact investments. This work was largely motivated by our attempt to better understand how do impact investors know and understand the performance of their impact investments, and how does that vary between investors across asset classes and other factors. And of course, I want to give a quick shout out to those on the line who contributed to this research. Your insights were so valuable in shaping this final product. And again, I'm just so excited to dive into it. With that, here are some key findings that surfaced from this research. And throughout this session, we'll flesh out each of these in further detail. So first, risk-adjusted market rate returns can indeed be achieved, contingent on asset manager selection and investment strategy. Next, we found that financial performance varies significantly across asset class and investors' investment objectives. And third, as the industry matures, impact investors are approaching performance assessment and capital allocation with increasing sophistication. And we really hope to hear those real life, on the field examples from our speakers later today. With that, let's take a deeper look at our first key finding. So as part of this research, as mentioned, we looked closely at financial performance data, drawing from the 2020 annual survey, as well as from existing industry research and resources. And across the board, we have found that financial performance varies significantly based on several facets, which could include geography, asset class, and the diverse set of objectives that investors pursue. So let's take a closer look at some of the data that has emerged. In this slide, we see, I just want to note that, of course, while public markets are growing rapidly and attracting a new group of impact investors, private markets continue to be dominant in the industry. This came up in the 2020 annual survey as well, which in turn shaped some of the internal and external scoping processes and methodology for this research. Given the binding of this research, this chart and the broader financial performance results that we'll talk through today all focus on only the 161 market rate seeking respondents to the 2020 annual survey, who allocate at least half of their portfolio to private markets. Among them, as you can see here, more than 3/4 are investing through private equity and just under half through private debt. So if we go to the next slide, in terms of actual financial performance data, we dug deeper into how average gross realized returns since inception varied among this subset of impact investors and across peer groups. So the diamonds you see here represent the average gross realized returns for a portfolio within that group of asset class and geography. And the whiskers on each end connect to the 10th and 90th percentile returns, illustrating the spread of performance.
Whoops, Nova, I think that we maybe lost your sound. If you want to unmute again.
Uh-oh, sorry. What about now?
You're back. You are back.
Okay.
Thank you.
Sounds good. Okay, so I was just explaining what the diamonds and the whiskers mean. The whiskers on each end connect to the 10th and 90th percentiles, illustrating the spread of performance. And broadly, we see that emerging market investments reported stronger financial returns than their developed market counterparts, and private equity investments report stronger financial returns than private debt. And this is across peer groups, which is not super surprising given the risk return characteristics of private equity and private debt. And I'll discuss this variation further in our next key finding, which is that financial performance varies significantly based on asset class, as well as the diverse set of objectives that impact investors pursue. So let's start off by looking at private debt investments. So private debt, as I mentioned, is the second most commonly used asset class in the industry, with nearly half of impact investors allocating impact capital through private debt. In addition to geography, we also explored performance here across peer groups, those that make exclusively impact investments versus those that make both impact and impact agnostic investments, between the energy and food and agriculture sectors, and between investors of various sizes. Overall, what we see here is the private debt impact funds can generate risk-adjusted market rate financial returns, and that returns here remain stable and largely aligned with investor expectations, which reflect some of the key characteristics of the private debt asset class. We also see that investors making both impact and impact agnostic investments reported higher average gross returns than those making only impact investments. And investments into energy reported higher returns than those made into food and agriculture. And last but not least, small and medium-sized investors reported higher gross average returns than larger investors. These findings largely resonate with those from other research that are featured in the full report, which also highlight that private debt impact funds are low-risk investment vehicles offering diversification benefits and low volatility. Moving on to the financial performance of private equity investments, again, we find that they can definitely generate market rate returns depending on the various investment goals and objectives of investors. However, as expected, we see that financial returns vary significantly, and there's much higher dispersion here in performance than for private debt. As we can also see here, across peer groups, emerging market-based portfolios reported higher realized returns than their developed market counterparts. It's also interesting to see that portfolios focused on emerging market food and agriculture report significantly higher returns than portfolios focused on emerging market energy. And last but not least, smaller funds tend to outperform market and investor expectations, which is also a key finding in some of the other private equity research pieces that are featured in the full report. In moving on to the next slide, in addition to private debt and private equity, we also explored what financial performance looks like for investments made into real assets. Overall, we found that there is significant dispersion here, and it plays out across various categories of real assets, such as real estate, infrastructure, and timber. Also notably, nearly 2 in 3 real asset investors reported significant macroeconomic risk, and over half report significant liquidity and exit risk. So this is all a pretty high-level overview of the performance across these 3 asset classes, but we have a lot more insight in the full report, which is also categorized by each of these 3 asset classes. So hopefully that makes it a little easier to skim. Findings are synthesized also across other key financial performance research and benchmarks in the industry, in addition to GIIN perspectives and the 2020 annual survey data. With that, again, we won't pause for questions just yet, but feel free to send any and all questions in the chat, and I will pass it over to my colleague, Sophia Sunderji, to walk us through the 3rd key finding.
Wonderful. Thanks so much, Nushin. And thanks again to everyone for joining the line. And so our 3rd and final key finding is that impact investors are approaching impact investment performance and decision-making with increasing sophistication. In fact, really what we're seeing is that impact investors are balancing a variety of facets that includes not only financial performance, but also others related to impact and risk. Nushin had shared some data on financial performance, but to further contextualize that, we also explored what this data means in the context of investor expectations. And what we see here on this slide is that the vast majority of market rate seeking impact investors are either meeting or exceeding their financial performance expectations. About 71% report performing in line with their targets, and then another 19% report outperforming those goals. And the same holds true on the impact performance side, as you can see here. So it's very clear through the data that impact investors are overwhelmingly satisfied with their performance. To better understand the why and the how, we've dug a little bit into the choices that impact investors are making to achieve outcome efficiency. And just to take a step back, we know, of course, that all investors make choices. Investors are constantly making choices to help them achieve their own objectives, and to determine how to achieve the best possible financial return for the least amount of risk. For impact investors, we add in that additional factor of impact. And this we all know. Ultimately, what we see is that impact investors are looking to deploy the minimum amount of capital to achieve the best combination of financial and impact return. Or in other words, for each dollar invested, what is the best financial and impact return that can be generated relative to an investor's objectives and really what they're looking to achieve. What we've identified in the research is that impact investors consider at least 6 different factors when weighing up their choices that will help them to achieve optimal portfolio performance. And this isn't really seen as a compromise, but rather a series of deliberate choices that we're referring to as dynamic decision-making. And so these are the 6 facets that we've explored. Of course, typically most investors will set out their financial and impact objectives. And so those are the first 2 facets that you see here. The next 2 facets are based on the level of risk tolerance for both of these. The 5th one is resource capacity. And so this refers to the extent to which an investor has the skills, funds, resources to provide for what it takes to manage an impact fund. So thinking through what's needed to set impact targets, measure results, and then go and report on those results. And then finally, the last facet that you see here is liquidity, or the amount of time that the investor actually has to remain in the investment before they need to exit in the case of equity, or realize their investment in the case of debt. And so if an investor weighs up these factors and pulls on different levers, so to speak, we can see how the dynamic changes and how these facets may influence their outcome efficiency. As you can imagine, this of course looks quite different across investors given the tremendous diversity in our industry. And what we offer in the report is a series of 5 spotlights looking at how different impact investors balance these facets to achieve their performance objectives, and really what that looks like in practice. And we're really looking forward to hearing from Danette and Antonia in just a few minutes. But the other element, of course, that's related to this is portfolio construction. So I'll hand it over to Leticia to share the latest IRIS Plus guidance that's come out on portfolio construction.
Thank you, Sophia. So this week, we published a new guidance document called Using IRIS Plus to Build an Impact Portfolio, which is part of the how-to guidance series of IRIS Plus. So as you may well know, there's 2 types of guidance that IRIS Plus has. There's the fundamentals that help you understand how the system works. For example, explains the taxonomy and all the themes and what's included in the theme, in each of the themes and whatnot. And then we have the how-to series, which is very practical and addresses specific topics that we have heard from investors as being areas where there is more guidance needed. And so, for example, we have guidance documents on conducting impact due diligence or incorporated stakeholder voice. So this is the latest one. And really what it does is that it outlines how investors can use IRIS Plus to inform decision-making when building an impact portfolio. And the reason why we are mentioning it today is because it touches on these different factors that Sophia mentioned that make up this multidimensional decision-making that investors go through when they build their portfolio or as they go through other aspects of the impact investing cycle. Next slide, please. And so just to tell you a little bit more of what's there, so if we refer to the impact investing cycle as having 4 phases and acknowledging that investors, different types of investors might call this in different ways, but just bear with me here. And in general, I think we could agree that, if you start from strategy setting and then you move to screening and due diligence, later on into investment management, and finally to exit, whether that's an equity exit or is the debt the maturity of your debt. If we think about those as the 4 main phases of the impact investing cycle, this portfolio construction piece actually focuses on the strategy setting one. So on that first set, and which includes, the setting of impact and financial goals, assessing risk tolerance, both for impact and financial risk, determining liquidity preferences, and then evaluating resource capacity. So as you can see, a lot of these are the same that Sophia was just talking about, that make up that dynamic decision-making that investors are making more and more. And so this guidance piece, walks you through how IRIS Plus can help you with each of these, and also provides an illustrative example of an asset manager who's building a portfolio, a climate-focused portfolio with IRIS Plus, and how they go through all these decisions. So I think what's, one of the things that come up from this report, and we're going to dive into now, is that this dynamic decision-making looks different for different investors, because it depends on, what each investor prioritizes based on their context and their needs and their preferences. So that's why we're very excited now to pass the line to Danette and Antonia to hear on their end what this dynamic decision-making look like in practice and how do they go about it.
Wonderful. Thanks so much, Leticia. And maybe what I'll do here quickly, I see that we've got lots of questions coming in through the chat, which is great. What I'll do is maybe tackle a couple of these that are related to the research findings, and then we can press on to our speakers. And so I see there's one question that came in from Sasha on the methodology for this research and the research report, which is a fantastic question. Essentially what we've done in the financial performance report is provide a synthesis of existing research publications and benchmarks specifically on the financial performance of impact investments across private debt, private equity, and real assets. And so we've synthesized findings in those 3 asset classes and produced them for the report. But additionally, what we conducted is another set of analysis based on the data that we collect from impact investors in our annual survey. And this specifically was conducted based on data that we collected on realized returns since inception. I'm happy to either chat more about the methodology offline, but we also tackle that in the report itself, so absolutely feel free to take a look. And just to quickly respond to another question that came in around time horizon considered for the returns. So the returns that Noshin presented earlier, those realized financial returns, those are gross realized returns since inception. And there is actually additional content on longer term horizons and what that looks like in the report itself, produced by both Cambridge Associates and also Symbiotics on the private equity and private debt side. And I believe Cambridge also produces some good content on real assets for realized returns. And so you can certainly feel free to take a look at that in terms of the time horizon. So at this point, perhaps what we'll do is turn over to our speakers. I know folks are excited to see some real life practical examples, and we're very grateful to both of you for joining and offering to share some of your insights on how you approach decision making. And I'm also glad that we'll get some varied insights here with both the asset manager and the asset owner perspective. And so to kick us off, I'm pleased to introduce Danette Liv, who is a Senior Risk and Impact Officer at Incofin Investment Management. And Danette, over to you.
Thank you so much, Sophia. So given the time, I'll be skipping through a number of the slides, but you'll have access to it, and I'll be happy to elaborate further during the Q&A session. So if we could jump to slide 4 straight. So in preparing this presentation, do I have control on the PowerPoint or? Oh, okay, thank you. Can we jump to slide 4? So in preparing this presentation, I thought that the best way to kind of illustrate how Incofin uses the 6 facets in our investment process was to walk you through our investment process. So if we go to the next slide. So I'll briefly walk you through the investment process. While Incofin does both debt and debt and equity investments, I will focus on the equity side. On each slide, on the right-hand side, you'll see which of the facets is interplaying with the step. So in the first stage of investment is the origination. And here, the most important criteria is that we will only consider investments that are both meeting the financial return as well as the impact objectives of the fund. We'll do a number of screening and scanning in the market. And then to shortlist the companies, we will look at the financial requirements, which includes looking at the profitability situation of the company, the growth prospects, their outreach. But equally important is that we will also do an impact assessment, still at a high level case, which we will try to see that the social mission of the company is matching or aligning with the fund's social mandate. Ideally, we would also prefer to work with companies that have shareholders who are like-minded, but this is not a hard criteria. The tools that we would use at this stage is, for example, an exclusion list. We also use the IFC GMAP that basically looks at social and environmental risks of certain crops and commodities. And we look to work with agriculture companies that do have fair trade and sustainable labels. In the next stage, we will then, once the company is shortlisted, we will do a deep dive, looking at both the financial and the impact risks and opportunities of the transaction. So in terms of financial factors, they are the typical ones that I think most investors will look at. So it's looking at past and current financials, benchmarking against our past equity transactions return, expected defaults. On the impact side, we will spend a lot of time investigating 4 factors, starting off with their impact thesis. So it's very important that we will then try to understand if there is a genuine social mission that the company is trying to achieve. who they're targeting, what kind of benefits their product and services are offering, and how they are providing this service. And the tools that we would use is including like the Cerise Alinus tool for our financial institution portfolio. We also, for our agro product line, we have our in-house tool. And all of these impact tools are housed in an online platform called Ecos 2.0. From that online platform, the investment manager can generate a 2-page dashboard, as you can see on the slide. And this dashboard is annexed in all of our investment proposals that is then reviewed by the investment committee. From this analysis, we would then generate a list of red flags and opportunities, which for our equity transaction, we would use to further discuss and negotiate with the company. So for example, a typical kind of risk that we usually see is that while companies have strong social intention, they don't always have an impact reporting system in place, which then prevents them from tracking progress, from adjusting their strategy. So we see this also as an opportunity where we can then leverage with the company to bring in technical assistance to set up a reporting system, which can include things such as defining the indicators based on IRIS Plus, and helping the company set certain targets to match their social mission. So in the next slide, when we move to the closing and post-investment stage, how we try to mitigate the impact risk is by negotiating a 100-day value creation plan. And this plan is derived from the list of red flags and opportunities that we generated during the due diligence. So some typical kind of actions that we would request in the plan includes putting in place an impact reporting system, also in product development that are client-centric, so adding more products that are not just plain vanilla, but focusing on certain effects such as agriculture or sanitation or health. And then another one that we look at is encouraging the company to look at impact beyond the client, the end client. So for example, a focus on how they treat their staff, on whether salary levels are at acceptable levels, how they set incentives. We always try to get an active board seat in our equity investments so that we can influence the decision making and also gradually embed thinking around social performance. We would also push for the setup of an impact committee in order to ensure accountability and make sure that impact activities are not getting lost in the day-to-day operation. But in reality, we know that this is how we would want it, but it's not always possible in all scenarios to negotiate a 100-day plan. So this can happen when we are a minority shareholder. So this happened in a case in Colombia in a fintech investment. In that case, what we did was, instead of laying out a detailed plan, we built a business case around a few points that we had discovered during the due diligence. We leveraged this with a co-financing technical assistance, brought in some external advisory to help them with the workload. So this is another approach in when we are able to put in a full-fledged plan. If we go to the next slide, what we also try to do to mitigate impact risk is by focusing on measuring performance. So when we enter into an institution as an equity investor, we would initiate the putting in place of output indicators that we would work with the company to define those. And these would then be tracked throughout the life of the investment. These indicators would then be aligned with the SDGs and tracked at the aggregate fund level. If we could go to the next slide. I will skip this one on financial risks in the next slide. So in the last stage is the exit, here our goal when we exit is not only to make sure that we are delivering on strong financial returns for our LPs, but also to make sure that we're selling to a buyer that can sustain the impact efforts that have been made. So we do this by conducting a fitness and compatibility assessment, where we're looking at the buyer's qualities. And these include things as looking at the reputation of the buyer, the stability of their leadership, whether they are committed to social performance, if they have sector experience, also what is the rationale for their investment, and we would also do a check on whether they're a cultural fit for the investee. In reality, this is not always possible to conduct this assessment, especially in markets where we have very few buyers and very slim pickings. But still, even in those cases, we do have some hard no-go criteria on who we will sell to. So for example, we would not sell to a company who intends to liquidate the company, or if a buyer that has a strategy to move in completely opposite direction from the impact mission of the company. In this case, what we would do is we would spend more time looking for buyers that would meet our basic requirements. And if needed, we would go back to our fund and ask for an extension in the closing period. So far, this hasn't happened, thanks to the fact that our investment advisors are giving very clear instructions on the type of buyers we are interested in. But we already have guidelines in place to think just in case the situation comes up. In the next few slides, I provided some case studies. Actually, there's the one slide on the resource capacity. So essentially, because we are a double bottom line company, all of our resources are focused on trying to mitigate impact risks. And the way we do this is by having very specialized teams. So our investment team are specialized by sector. So a team for financial inclusion, a team from agro. We have a risk department that will then monitor compliance, and we have a dedicated technical assistant team that will focus on the capacity building efforts. And then on the next slides are case studies, which of two equity investees. So I won't go into it, but I'd be happy to explain it during the Q&A. So that's in closing. I'll hand it back to you, Sophia.
Wonderful. Thank you so much, Danette. That was just incredibly useful and practical, and really neat to see how those facets influence each stage of your decision-making process and the investment process, and especially the tools that you're using. So maybe I'll pause here and see if there are any questions for Danette. Feel free to share them in the chat, or feel free to unmute and share your question. I see we have one actually that came through from Sasha, and the question is around investment committee, I believe, and how many of these have you been able to set up, and how effective have they been?
Mm-hmm. So in terms of the number, I don't know the number exactly, but I know for an example, in the case study on rent to own in Myanmar, we did set it up, and our board member is the chairperson on the impact committee. And through that committee, we've been able to walk the company through in setting up an impact measurement system. So walking them through the impact thesis to setting up indicators and putting in a process where they can collect and track the performance. Of course, in reality, there's always like the best case, and then there's the other case where it's like much more challenging because there's still some resistance from the company. So we will work with the company at the stage that they are at and push as much as we can while respecting where they are at that stage.
Great, thanks, Danette. Are there any other questions for Danette before we move on? And again, feel free to share them in the chat or unmute and share them. I see actually there's another one that's come in from Chris, who is asking about the due diligence phase in particular, and wondering, how do you compare and evaluate the relative impact return on investment? Do you have impact thresholds? And the example he shares is around target beneficiaries for every dollar invested or other impact generated.
Yes, so this is a great question. We don't have like a specific impact return threshold, like a number. What we would do is, our goal is always to try to improve. So even if the situation of the impact performance is still at a low stage, if there's opportunities where we can help the company build it up through our investment period, this is still very important to us. There are certain criteria that we will look at. I mean, they still need to have basic minimum social performance situation in place, but it will be a case-by-case situation depending on the institution where they're at. So the idea, I mean, the message is, it's about progress and not so much about the level they are at.
Great, thanks, Danette. Perhaps at this point we can move on to our next speaker. So let me jump ahead to Antonia Sariska, who is in the Chief Investment Office at UBS Global Wealth Management, and her work focuses on sustainable and impact investing. Antonia, I will turn it over to you.
Thank you very much, Sophia. Thank you everyone for the opportunity to chat with you today. I hope my presentation will be equally helpful and practical. And perhaps I will start by maybe setting up a bit of a context of who we are and how we think about impact investing. And you probably know by now, UBS Group is a large multi-divisional bank. We're based out of Switzerland, but we have a global footprint. And we have a wealth manager, an asset manager, an investment bank, and a Swiss retail bank. But I am part of the global wealth management business. And I think this is probably a slightly different perspective from a perspective that we'll have from an asset manager or an investment manager as such. So I thought that was kind of important to highlight for the purposes of this case study. You'll see on the next slide that UBS Global Wealth Management focuses predominantly on private investors. So we serve private individual clients and family offices, while our asset management division tackles institutional business. So today I'm going to focus mostly on private investors and their engagement. In general, we manage around $3 trillion of assets from private investors across the world. And these are more or less equally divided between Europe, APAC, and the United States. And back in 2017, we made a pledge to mobilize $5 billion of this private capital towards impact investing. We achieved that target a year early, actually this year, or past 2020 year. But you see on the slide our number from 2019, which was 3.9 billion, and you can see that just the great investor response and investor demand we faced in the past few years, which I'm sure resonates with you as well, and you've observed the same. I guess the key element here is that we're a platform for private individuals and family offices, and it is our job to select best-in-class impact investments for them and their portfolios, where we have to take into account risk-return appetite, personal preferences, portfolio constraints, and so on. And in most cases, like we mentioned earlier, such impact opportunities usually come in the form of private market investments or private market funds, where we partner with third-party asset managers and investment managers to bring innovative solutions to our platforms. So we are always partnering with an asset manager when we bring a solution to our private clients. And it is our responsibility to assess whether these solutions are actually legitimate, quote unquote, impact investments. And we do that against our commercial criteria and our impact criteria. And we basically have to make sure that the fund does what it says on the tin before we advise our private investors to commit capital to it. And in this sense, I think that is really well reflected in our 6 facets case study, which you'll see on the next slide. When thinking through our 6 facets, we take the perspective of what is it that we and our private clients are looking for in an impact investing. And in our definition, just like in yours, financial performance and risk and impact performance and risk come hand in hand together in an impact strategy. And since these investments will be integrated into our clients' commercial portfolios, we would strain away from maybe social finance or more philanthropically focused investments and really focus on market rate returns for this kind of solutions. That part, actually, the commercial part, or the financial performance and the financial risk facets of our assessment, are actually handled by our, what you would call, conventional fund research colleagues. So these are the same people that assess our traditional private equity funds for our shelf. So they are the people who have the industry expertise. They know what strategies are out there. They're able to assess whether the financial risk return profile is what is generally accepted for the industry or for that strategy in particular, be it private equity, private debt, across venture growth, and so on. So they're usually the people with the expertise. And for the past 5 years, they've been assessing a lot of impact funds. So they've built a lot of expertise on impact as well, but their core job, their core business is to assess funds from a commercial standpoint, from a financial risk and performance standpoint. And then the other set of facets, the impact performance and risk, is something that we assess separately, and that is done out of actually my team within the Chief Investment Office. So we are basically in charge of conducting an impact assessment that I'll briefly outline a little bit later. And then when we think about our capabilities, probably I should mention that we've offered impact solutions for about 10 years now in different shapes and forms. But the franchise really took off about 5 years ago when we set up a dedicated expert team within the Chief Investment Office, within wealth management, whose sole purpose was to understand and build impactful strategies and portfolios and assess what kind of impact solutions we can onboard onto our platform. At the same time, in addition to this impact assessment, our main job is what we call capacity building, which is basically, it has allowed us to educate investors, but also our colleagues, our client and financial advisors, for instance, or our fund research colleagues, on what impact investments are, how they behave, what are some of the characteristics, criteria that we're looking for. So in a way that has let us use the scale of the whole UBS Global Wealth Management and what we do in our daily business to really integrate impact into sort of the everyday processes and everyday assessments. And we believe that's been a very successful strategy, especially when we're talking about the larger firm, where in many cases you'll be facing a lot of perhaps challenges or barriers to basically, educate colleagues on what they're supposed to do. So we felt that was actually quite a successful approach. And I think last but not least, when we talk about liquidity, we actually don't believe the liquidity is a barrier to impact, but we do recognize that the additionality of capital is well articulated in private markets where liquidity tends to be more limited. We do have 2 impact investing strategies in public markets. That's in ESG engagement and in offering multilateral development bank bonds, such as World Bank bonds, for instance. But both of these are sort of more liquid instruments and strategies. So they're probably not a part of the conversation that we'll have now. So having gone through the 6 facets, I wanted to maybe briefly walk you through our impact assessment, because I felt it was a good reflection of how we think about impact performance and impact risk. And on this slide, you can see basically our 3 very high level criteria of how we look at impact investing fund managers. So when we think about them, we think about the fund manager's intent to create impact. We think about the measurement of that impact and the verification, or in other words, the contribution of the capital towards impact. And we would also consider the manager's internal impact capability. So similar to us, to what we've done, we would expect the fund manager to have built an internal impact capability. And that can be across their sort of conventional investment teams, that can be embedded into their investment committees, or that can be a dedicated expert team. But basically what we want to see is they walk the talk. They're not just saying they're intentional, they're actually building a team and a knowledge and expertise around being able to deliver impact. And we believe that it's a very important aspect of the risk assessment, the impact risk assessment, especially because our job here is not only to assess whether the fund ex ante, right, in the fundraising stage is impactful. Our job is then to monitor that fund, monitor that fund manager, have these conversations, engage with them during the whole investment period of the fund. So we'll be in touch with these fund managers for 5 years plus, right? We still haven't, quote unquote, exited the fund in a way. but that's why this risk element will be very important to us. Is this manager prepared to handle impact, especially when we're talking about maybe some of the more mainstream private equity managers who are just developing their first impact private equity funds. We also take into account the manager's alignment to the operating principles for impact management. We don't require the fund manager to be a signatory, but we believe the principles provide a really nice checklist or principle format against what we would ideally want to see from how the impact management and measurement framework is set up within the fund manager. Of course, on the next slide, you'll see we use the 5 dimensions of impact, which are not new to anyone. We would also query the fund managers on what they use for measurement and how they approach measurement. We've seen that the increasing number of them do use IRIS Plus as a framework, which we like. But for us, it's also important to make sure that this measurement is actually relevant, right? They've picked the relevant metrics. They're going to be able to monitor them over the lifetime of the fund. And most importantly, they're going to be able to make decisions based on that measurement, right? So it's not just a matter of, checking numbers every year. It's more a matter of, okay, now what? Is this enough? What is our benchmark? Are we engaging at this point? Are we happy? Are we not happy? Can we do more? Can we do less? And so on. So measurement, definitely a very important part. And then on the next slide, I wanted to highlight some examples of impact investing private market funds that we assessed and then ultimately onboarded onto our platform. You see a bit of a timeline history. I've only mentioned the ones that, that are closed and they've been on our platform. And you'll see some highlights. You will see some of them are sort of very much single strategy, single thematic funds. So for example, there was one focused on SMEs, there was one on microfinance, there was on oncology, but you also see maybe some of the more multi-thematic offerings probably coming across from the larger traditional private equity managers such as TPG and KKR. But I wanted to give a quick example, maybe more in detail, and that's on this last slide. And this is what we call the UBS Oncology Impact Fund, which is a strategy that we partnered with where we partnered with a US-based manager called NPM Capital. It's a healthcare fund manager. And we raised nearly 500 million at the time for the fund. From a financial performance and risk perspective, just going back to the 6 facets, from a financial performance and risk perspective, this was a hybrid private and public equity growth strategy, which was investing in a growing field of healthcare, which is oncology therapies. And now our fund research analysts, they saw an opportunity in that sector. They saw a lot of exciting innovations and technologies and therapies coming out in the market where they believe there will be a growing demand in the future. So they believed from a return standpoint, this would be market or above market return potential. From an impact performance and risk perspective, we consider that the strategy invested in the most actually underfunded part of the value chain of therapy development, which is what they call the valley of death. And that's the gap between initial academic research, which is mostly funded through public finance, and then proof of concept in clinical trials, which is usually financed by private capital and also sort of larger corporate money like pharmaceutical money. But there was really a gap in the middle of how do you take this research and you turn it into actual therapy. And this is where we found a niche, and this is where we engaged with NPM to fund that gap in the market. Now, this fund in particular had a nice philanthropic element to it, but this is not a requirement for us. So it was just a nice add-on in that case. And the philanthropic element was that we partnered with the UBS Optimus Foundation, and we channeled some of the proceeds of the fund towards actually cancer research and therapies access in developing countries, which again was a nice add-on, but not a requirement for an impact investing fund on our end. I'm gonna take a pause here, and I've really enjoyed sharing some of that platform ideas with you, and welcome any questions.
Great, thank you so much, Antonia. That was incredibly useful, and especially how you walked us through this example and sort of showed how the Optimus Foundation also plays a role in that impact investment. So thank you so much for that. At this point, we have just under 10 minutes, and we are open to questions, and so feel free to share those in the chat, and happy to tackle questions now.
And then as questions come, just one thing to jump in. In the report that was published, we have both the spotlights, UBS and Incofin and part of it, so you can learn more about them there. And then there's 3 others, right? There's a total of 5 spotlights, right? So there's
Exactly.
3 others also to get a sense of how different investors go about dynamic decision making.
Thanks, Leticia. I see that we have a question from Stefan, and this one is for you, Antonia. And Stefan is wondering if you could please describe the RISE fund model.
Sure, I can, and I probably would not do it justice. Probably it's much better coming out of TPG. But when we partnered with the RISE Fund, that was already now 3 years ago, I believe. It is a multi-thematic private equity growth stage model. They focus on a number of different solutions, from healthcare through education technology through some of climate solutions. So very much multi-thematic, which I think presents a challenge and an opportunity when you talk to private investors about. I think one interesting feature of the RISE Fund is that, and TPG ended up spinning that part off, but they've tried to come up with a way to quantify the impact of the fund in terms of dollar amount, and they called it the impact multiple of money, which I thought was an interesting approach. They also have something that they call an impact council, the RISE Council essentially, which is basically a collation of sort of experts coming from industry, government, from impact field work, and so on, that really advises the investment committee what are some of the growing needs out there, what are some of the growing opportunities. I also think it's a nice way of highlighting how a mainstream private equity manager can really start building impact capacity. So in addition to their council, they also have a dedicated impact team, but that impact team works hand in hand with basically what you call the conventional geosourcing and sort of due diligence teams in making sure impact is integrated into the investment decision making for that particular fund.
Great, thanks, Antonia. I see that there's another question from Sasha, which is great. Keep the questions coming. That's very welcome. And Sasha is wondering how you evaluate whether decisions are being made based on impact data.
Sure. So when we do our ex-ante assessment, so we basically do the assessment of the fund while it's still in fundraising stage. So we rarely have an actual portfolio company or a case to go by. So at that stage, what we will be looking at is mostly frameworks and how the fund manager thinks about impact. So at that point, they need to tell us, this is our thematic framework, this is our objectives, these are areas we want to address, these are challenges we want to address, and here's how we're going to measure our progress. They also need to show us that they're actually capable of measuring that. So we know impact measurement can be very tricky, very costly. It requires an additional set of capabilities sometimes. So they need to be able to show us that there is potential to do that. But most importantly, we ask them for something like to link that measurement to the theory of change or logic models sometimes, to show us, okay, so if you have a benchmark or reference point in 2 years and you expect the company in that sector to do X, what happens, what are some of the engagement models you would have, etc. So this all happens ex ante. Now, once we fundraise for the fund and it's closed and it's off our shelf and now it's an investment stage, so the fund manager starts deploying capital, we would actually have quarterly touch points with the fund manager on impact specifically, and we're going to walk through every portfolio company. We very often have the opportunity to walk through that in a very early stage. So they're just making that investment decision and they've just decided, they want to invest in that company, and they're outlining what their theory of change is and what their measurement is going to be. Or sometimes we talk about, or very often we talk about portfolio companies that have already been in the portfolio for, let's say, a year or a year and a half. And we're like, okay, so what happened with the metrics? What did you do? How did you do it? So it's kind of like engaging with the fund manager to engage with the company, if that makes sense. But we will have this quarterly touch points on impact throughout the life of the fund, actually. And we would require the fund managers to report on impact annually in an impact report that we'll be able to share with our private investors.
Thanks so much, Antonia. We've got another question that's come in, and this one is for both of our panelists. So maybe I'll ask that Danette, you respond first. And the question is, do you incorporate diversity, equity, and inclusion into the decision-making process? And so thinking about from the pipeline to investments and from who's receiving the capital, who are the affected communities of the investment, that sort of thing.
Sorry, what was the question? I don't see it in the chat.
Oh, sorry, let me share it again. I think it was sent privately, so let me copy it into the chat. But it's a question around whether you incorporate diversity, equity, and inclusion into the decision-making process.
I mean, I think those principles are always guiding us, but we don't have any specific thresholds. So, I mean, our funds are structured around the concept of inclusion and sustainability. And so when we select the companies to invest in, and when we make the investments, these are the concepts and the guiding principles. So, I mean, as I've walked you through our investment process, trying to achieve the sustainability targets of the funds is assessed throughout the process and then measured throughout the life of the investment.
That's really helpful. Thank you so much, Danette. And any quick comments from your end, Antonia, before we wrap up?
Sure. So in terms of diversity and inclusion, we would have a standard set of questionnaire where we would assess the fund manager's sort of diversity and inclusion position as a corporate, right? So what are they doing within their own company about it? And that will be applied to all of our private market funds, regardless of whether they're qualified for an impact investing shelf or not. But more specifically, we come across quite a few funds whose strategy is actually to address diversity and inclusion explicitly. So for instance, we recently partnered with a fund manager called Rethink Impact over in the US, and they invest in SMEs started by female founders, for instance. So sometimes we would also see these kind of strategies, but across the board, we would expect a diversity and inclusion policy, but also leaving the talk from the fund managers on corporate level.
Wonderful. Thanks, Antonia. And thank you to both Antonia and Danette again for joining us. In our final minute, I'll pass off to Leticia for some closing remarks.
Thank you, Sophia. Thank you to both of our speakers, Antonia and Danette, for your great presentations. And thank you to all for joining us today. Just to share that you can find a lot more of what we discussed today in our report. So if you go to find the decision-making report we've been talking about, that's on the GIIN's website. And then to find the how-to guide on building an impact portfolio, that's on the IRIS Plus website. And we have a lot more there also both on the GIIN and IRIS website in terms of understanding impact performance, as well as the methodology for standardizing and comparing impact performance. More webinars will be coming also on these topics in the coming months. And as we said, we have been recording the session today, and we're going to post the recording together with the slides on our website. On the IRIS Plus website, you can find it under webinars. So with that, thank you all. Hopefully we answered all your questions, but if anything else comes up, you know where to find us. You have our email, so just shoot us any questions and we'll be happy to continue the conversation offline. Thank you, everybody.